Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, 27th of August. In other words, it's Nvidia earnings day. The company will report its second quarter earnings after the bell today amid ongoing concerns regarding the Fed and the Fed's independency, Trump's interference in companies' internal affairs, the trade war topped by French political drama, and the rising long-term yields in developed bond markets. So we will talk about the risks to the summer rally and ways to protect against a potential market meltdown. But before we do, please keep in mind that opinions are my own and this is not financial advice. So this week started bad for the French assets, to say the least, as the French PM there called for a confidence vote next month. That opposition parties obviously responded saying, no, we have no confidence in your government. So the euro-dollar consolidated below its 50-day moving average yesterday, despite a broadly pressured US dollar, which feels the pinch of a growing fight, obviously, between the Federal Reserve Governor Lisa Cook and the US President Donald Trump, who just tried to fire her without necessarily having the authority to do so. But ultimately, Donald Trump is accumulating a few things that no one has done before in the US government as a US president, like firing people, replacing them with people he loves, imposing tariffs on trade partners, asking to be paid a cut from companies' revenues on their private and their own businesses, and also telling companies what to do and what not to do. So the American story has come down to a one-man show and not everybody is amused. The short end of the US yield curve is loving the softening Fed story, as if Donald Trump manages to oust Lisa Cook, and he's managed to get away with many things that he's done so far that seemed impossible, well, he could eventually obtain majority in the decision committee of the Federal Reserve and indirectly decide the Fed policy. The long end of the US yield curve, however, is under an increasing pressure, as inappropriate rate cuts from the Federal Reserve would boost inflation and require higher interest rates down the road, along with the exploding debt that doesn't look appetizing. As such, the US 30-year yield continues to flirt with the 5% psychological mark, and the steepening of the US yield curve, combined with rising sovereign bond yields across other developed nation markets, also increases the worries among global investors that at some point in time, investors will be willing to go to the bonds market to lock in the juicy returns, therefore lower risk investments. I mean, the UK's 30-year gilt yield now is around 5.60%, Australian 30-year paper yields above 5%, a European Gojo 30-year paper yields 3.80%, and the Japanese 30-year JGB yields 3.21% today, while the S&P 500's earnings yield, which is comparable to these sovereign yields, is now around 3 to 4% due to rich valuations. We are pretty much near the bottom of the average historical range here, hinting that if investors acted rationally, we would see a readjustment in positioning, meaning a rotation from riskier equities to lower risk bonds in a way that the former would promise a higher return compared to the latter for, well, having a higher risk. So this is how I feel coming toward the end of this summer. So that's pretty much it. The bullish summer that we had, where stock markets rallied on various trade deals, stronger than expected earnings from the S&P 500 companies, and softening Fed expectations. While this could leave its place to risk of positioning, rising worries about the Fed independency and the US government's internal and external policies, some of these policies being, well, pretty much unprecedented for a democracy like the United States. So today will pretty much mark the end of the earnings season for the S&P 500 companies, as Nvidia will be revealing its second quarter results today after the bell. And because the company makes about 8% of the S&P 500 and is the proxy of the AI theme, its results, or more precisely the reaction to its results, could be a market-moving event or could eventually be a trend-reversing event as well. As per the earnings, the company will probably hit its $45 billion revenue target plus or minus 2% on AI spending from big companies like Microsoft and Meta that make up to around 40% of its total revenue, and explains why and how the earnings of Nvidia have been so predictably in line with the company's own expectations. But on top of it all, Nvidia could also announce improved profit margins, and that would be eventually thanks to the Chinese export ban derogation that the company just obtained from Donald Trump's administration in exchange of, well, you know it, paying them a 15% cut on their Chinese sales. Yet the Chinese headache is probably not over just yet, as now the Chinese companies who no longer want to buy the American chips because their government actually asked these businesses, Chinese businesses, to buy local and Chinese chips. So what will happen on the Chinese business front? And the company's forecast will be one of the major focuses of investors today. Geopolitical and competition risks are looming, mind you. Nvidia is trading today with a PE ratio of around 58, which is high, but which is still bearable if the company's business continues to grow the way it did over the past 2.5 years. Now, the Chinese exposure for Nvidia is much lower today than it was a few years ago, mind you, as only around 13% of Nvidia's total revenue comes from China today. And on top of it, Middle East has emerged as the next big client for the company, and they have quite a lot of money to spend on Nvidia chips. So I believe that Nvidia could eventually meet and beat expectations both on earnings and the forecast, and some announcements regarding China could upset, but potential losses in China could be eventually recovered elsewhere, like in the Middle East, and the big spenders will probably continue to spend and to buy from Nvidia their chips, defying the concentration risk of doing business in a small circle. Now, pricing in options imply that we could see a 6% move towards the upside or towards the downside following Nvidia's earnings announcement, and the latter could eventually lead to a 0.8% move in the S&P 500 to the upside or to the downside, just related to Nvidia. Then you would obviously have the overall appetite emphasize any move that we would see after Nvidia's earnings announcement. We are not sure that strong earnings will lead to a strong market rebound, mind you, as investors have quite high expectations for Nvidia and could be eventually tempted to take profit and move to the sidelines. So if that's the case, the market could rapidly be pushed into the correction mode. So the question here is, if that happens, how do you protect against a potential downturn in the space without, however, limiting your upside potential? Well, there are a few options, few things that you could do actually to hedge against risks without necessarily cutting or limiting your exposure to your darling's upside potential. Put options, for example, or other option strategies could be interesting hedges, and they see quite good demand these days for trimming downside risk, but they obviously come with a cost. So another alternative, which looks simpler, is buying VIX futures that are actually trading at surprisingly low levels right now. But here you must get the timing right, because VIX spikes are short-lived and a hedge might not perfectly offset losses unless it is timed with market volatility. Then we have diversification as another alternative, and it's probably the best option when you feel like a downside correction could happen in some pockets of the market, but you do not know when. So by adding diversification to your portfolio, you could eventually have a positive carry. So that means that you would be earning income while holding the hedge and wait longer until markets and investors get back to their senses and the price and valuations readjust. And diversification could be sector-wise, mind you. If you like technology stocks, for example, you could tap into Chinese or other Asian technology space. It could be across sectors, so you could move into more defensive pockets of the market like consumer staples and healthcare, and decrease your exposure to highly valued technology companies. Or it could be across asset classes, obviously. Gold, treasuries, and government bonds are the most typical hedges against market risk, and we start seeing interesting yields over there as we talked about it earlier in the session, while investment grade bonds could also benefit from lower policy rates. So take your bets. Nvidia is about to say the last word for this summer. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please don't hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.